In this video, we'll talk about how to use information from a firm's financial statements to compare that firm's performance to its past performance or to other firms. First, we'll talk about common-size financial statements and common base-year financial statements. Then, we'll talk about ratio analysis. Finally, we'll touch on the DuPont identity. A common-size statement requires every figure to be stated as a percentage of some selected benchmark. This makes it easier to compare the firm to its own previous year's data or to other firms. A common base year statement requires you to pick a base year and then state each account as a percentage of the corresponding account from the base year. The best way to understand either is to just go ahead and make one. Pulling up the sample statement of financial position we looked at briefly in the previous video, let's try and convert it into a common size statement. In a common size statement of financial position, all accounts are stated as a percentage of total assets.
We'll just focus on the asset side, but realize that we would do the same for the right-hand side of the statement as well if we were doing this in a whole question. The cash amount in 2015, 123, divided by the total asset amount in 2015, 3,072 times 100 equals 4%. Doing the same for the accounts receivable, 234 over 3,072 times 100 gives us 7.62%. And for inventory, 345 over 3072 times 100 equals 11.23%. So on and so forth. Now, hopefully you get the point, so let's just pull up the completed version of the common size statement and comment on it. As you can see, all the amounts add up to 100% at the bottom. In essence, that 100% tells us the whole pie for 2015 is there, and the percentages above help us identify how much of the pie is current assets, how much is fixed assets, and how those break down further, which can be useful to know and help us identify things like where the majority of the firm's money comes from, and what comprises the firm's value.
A common-size statement of comprehensive income lists everything as a percentage of sales.
The process is similar for the statement of comprehensive income. So again, pulling up the sample statement we used in the last video, 1612 over 1612 is 100%. But moving down the list to cost of goods sold, 701 over 1612 is 43.49%, which tells us immediately that for every $1 in sales we generate, about 43.5 cents is the cost of making and selling the goods. Again, hopefully the point is sufficiently clear, so we can pull up the completed common size statement where we've already converted the number values into percentages. The information communicated by this statement is slightly different. Suppose, for example, your company is making lower than expected profit. Having the statement presented in this fashion makes it easy to determine that the biggest drain on revenue is the cost of goods sold, and after that, it's taxes. So with that information, we could make a decision like revising our methods of production to reduce the cost of producing each unit.
We won't repeat this process with the statement of cash flows, but typically items are restated as percentages of total sources or total uses of cash. We can also create a combined statement by first creating a common size statement and then picking a base year and stating subsequent years in terms of percentages of that base year. Again, an example would be best. So let's go back to the common size statement of financial position that we created earlier.
Since this is already a common size statement, all we have to do is restate the amounts taking 2015 as the base year. Obviously, in that case, all the 2015 amounts will be 100%, because we will be dividing them by themselves, and anything divided by itself is 1. Now for 2016, we begin by dividing 12.58% by 4% times 100 to get 314.29%. For accounts receivable, similarly, we divide 7.71 by 7.62 times 100 to get 101.2%. The completed statement looks like this. Comparing it to the regular common base year statement, we see that the changes from year to year in the combined statement are lower across the board. This is because the combined statement adjusts against the natural growth in all accounts which accompanies an overall growth in assets. Another set of tools in the financial expert's arsenal is financial ratios, which help us summarize information on a firm and make snap comparisons.
It's generally agreed that ratios fall into one of 5 categories. Liquidity measures are concerned with a firm's ability to pay its bills in the short term, and thus focuses on current assets and liabilities. Leverage ratios give insight into the company's financing methods and the mix of where the company draws its capital from. Turnover ratios determine the firm's efficiency in using its assets to generate sales. Profitability ratios measure a firm's ability to generate earnings relative to its expenses. Market value ratios can ascertain how the firm's economic status is, whether the company's stock is over, under, or correctly valued. A quick note that there are a lot of financial ratios, and the ones presented in this video are a small sampling of some of the more common ones. We've got a lot of ground to cover and not a lot of time, so let's do speed round of ratios. If you miss anything, don't sweat it. Pause and rewind at your leisure. Current ratio, given by current assets over current liabilities, measures short-term liquidity. Higher is generally better for short-term creditors, but can also indicate inefficient use of current assets. Should equal at least 1 for healthy firms. Quick ratio, given by current assets minus inventory over current liabilities. Same as the current ratio, except inventory is omitted because it's illiquid relative to cash and likely is to have a market value significantly different from its book value. Total debt ratio, given by assets minus equity over assets, measures how much debt a company uses as a percentage of its assets. There's no consensus on the optimal level of debt. How leveraged a firm is could be characteristic of its industry rather than its debt policy, but by comparing our firm's total debt ratio to other competitors, we might be able to see if we're in a healthy range. There are two variants of expressing this ratio, the debt equity ratio or the equity multiplier ratio, shown here. We can calculate any of these given one of the others. Inventory turnover, given by cost of goods sold over sales. Higher is better because it means the company is able to push out its entire inventory that many times over the year. Day sales in inventory. Variant of expressing inventory turnover. Allows us to state how many days it takes before the current inventory has been pushed out. Other turnover. By dividing sales by either accounts receivable, accounts payable, fixed assets, total assets, or net working capital, we can understand how many dollars in sales we were able to generate relative to any of them. Profit margin, given by net income over sales. The closer the margin is to 1, the better, since the higher margins mean you generate more profit per dollar of sales. Return on assets, given by net income over assets or net income over sales times sales over assets, measures profit per dollar of book value of assets. Return on equity, net income over equity, or net income over sales times sales over assets times assets over equity, measures profit per dollar of book value of equity. Earnings per share, given by net income over shares, provides the dollar value of earnings per outstanding share of common stock. Dividends per share, given by dividends over shares, provides the dollar value of dividends per outstanding share of common stock. Dividend payout ratio, dividends over net income, measures the percentage of earnings paid to shareholders in dividends. Retention ratio, retained earnings over net income, or 1 minus payout ratio, measures the percentage of earnings left after paying dividends. And now, as I catch my breath, we come to the DuPont identity, which is a movie in which a CIA agent suffering from memory loss, played by Matt Damon, must rediscover his identity while dodging a conspiracy to frame him for... Wait, no, that's the Bourne identity. The DuPont identity is actually just a mathematical proof demonstrating the relationship between return on equity and its constituent parts, which are profit margin times total asset turnover times equity multiplier. We won't worry about how this equation was derived, but it is important to understand what it tells us. Basically, return on equity is affected by 3 things. Operating efficiency, represented by profit margin, asset use efficiency, represented by total asset turnover, and financial leverage, represented by the equity multiplier. If our ROE goes up or down, we know exactly what variables to look at to determine why. We can use the identity to solve for missing information, so let's try it out in this sample problem.
Ethelbert Inc. has sales of $5,276, total assets of $3,105, and a debt equity ratio of 1.4. If its return on equity is 15%, what is its net income? Restating the DuPont identity, we know that return on equity is given to us by profit margin times total asset turnover times the equity multiplier. And we know that the profit margin is equal to net income over sales, which we're going to use S to represent, times sales over assets times 1 plus the debt equity ratio, which is the most direct way of getting the equity multiplier for us, given our information. So we plug in our values of 0.15 for return on equity is equal to net income we're going to leave as is because that's what we're looking for. And sales are 5,276 times 276 divided by 3105 for assets times 1 plus 1.40. Now rearranging to isolate for net income, we find that we get 0.15 divided by 5276 over 3105 times 1 plus 1.4, all of that times 5,276. And that should give us a value of $194.06. That brings us to the end of the video. Still confused? Rewind to the relevant part of the video by clicking on the sections listed to the left. For more, be sure to take a look at the tip sheets uploaded to the Academic Success Center website by following the link in the description. Need a more face-to-face approach? Check out tutoring hours at the Ryerson University Academic Success Center's website.